What's going on, Chris here? The biggest thing we're looking forward to is next week, going into Wednesday and Thursday. Biggest thing that people are trying to figure out is what the Fed's going to do. Fed funds on Wednesday, the FOMC conference on Wednesday, and then Thursday, unemployment claims. And if we were to take a look at what the institutions are doing, they're starting to become more neutral and get out of their longs. So I think what they set out to do, they've pretty much achieved. Whatever is powering the market is more of retail. So we're seeing a shift in institutions. The higher the market goes, the more the institutions will dump. So we filled the first daily fair value gap right here. The fair value gap is the candles outside the engulfing, the one before, the wick low, which is there, and then the candle after, the wick high, which is there. We filled it to the tick. We came back down off those highs. Now the question is, do we attack this one next? And I'm uncertain. What could end up happening is this is the deviation, and we get back below. It's totally possible. It's something I'm looking as an ongoing development. If we get back below this zero line and this ends up being resistance, that's really bad. It's something that makes sense on the diagonal trend lines. It's not something that is for certain, but we got this diagonal trend lines that if we reclaim the downside and that downside becomes resistance, like I showed you, that zero line, and we get a close, I guess on the day back in here, it would show like a doji on the weekly. Anything below that basically blue line is the zero line, and it would count for like some kind of doji. It would be really interesting to see a weekly close underneath this moving average channel line 39.26 spot 97. But if we get a weekly close as a show of rejection underneath, and then we come up and next week we try to retest it, and that becomes a big sign of just weakness coming into here, we could pretty much assume that the institutions have left the building, and it's a bull trap because of this resistance here. Right now it's undecided, but it's an ongoing development. We are kind of in the middle of no man's land, like literally on the slow. We've already had, I guess, our attempt into weekly resistance that was support for one candle, two candles, three candles, four candles. Broke it on this candle, and then retest it on this candle. And we're seeing just kind of the end resolution of this week, and I think it's called witching this week. It's either this, yeah, third week of this month. So we're seeing just the resolution. I think that will really flush out come market open. And if we were to, so we looked at the institutions and what they're thinking. If we take a look at just the mass cycle, if we look at the intraday kind of analysis, we get rid of the Bartels and just look at the Q Spectrum 2. This is kind of the forecast for Friday. It's assuming, and for the most part, it's confluent with the Bartels. So we got the traditional waveform analysis, and then we got Bartels, and they're both confluent to the downside, as we can see here. As we get farther out, they're less confluent, they're more divergent. But with the Q Spectrum 2, we got more cycles that it sees automatically, AI cycles. If we go to the trading spectrum for some kind of a fast and slow kind of expectation for intraday, we could see here zooming out. We got to zoom a little bit farther back in, zooming out, but forward. We could see around Wednesday, the 22nd, and Thursday, the 23rd, that we're getting some kind of peak around there. And if we were to do the intra-week analysis, going using the Yahoo data feed, we could get a similar kind of analysis intra-week, which is confluent surprisingly enough, with the intraday slow signal. So that's I don't see that very often, but it's definitely special when I see it. But if we take a look at the analysis, we have it calculate, and then we hit the Q spectrum 2, and then also the trading spectrum, and we could see just by the AI selected cycles with a larger scope, we're getting pretty much the same exact thing. And then if we look at the trading spectrum, which has the walk forward analysis, it's basically confluent and agreeing with this Wednesday and Thursday as like some sort of like significant event as a downturn kind of signal, and this is mostly best for reversals, as you can see, not necessarily the general direction. The significance we will leave to the market structure that's broken, and this is the decennial. This is, instead of forcing the AI to look for things, we're forcing time and the computer to find cycles based upon the time. That's the decennial, the 10-year annual, and it's basically saying, hey, around here we're looking for a top, and that's pretty much it of all of the kind of smart money. If you really wanted to go the direction of the smart money, the Fed is technically the smart money because they control the rates, and with the current rates, if you were to take a look at the key economic fundamental data, we would go to figuring out what is the inflation rate, and once you know the inflation rate, you know basically how close to the target the Fed or the smart money is. And we look at the US dollar, it's 6% inflation, and we know both the ECB and the US Fed target inflation is 2%, and they are far from it. You got US dollar, the US being 6%, so they're 4% away from their target. So, and then the euro is the ECB is 8.5, and they are far from their 2% target, and it just implies that there's more hiking to be done. If you take a look at Frontline's documentary, it seems like they are pretty dedicated, based upon the whole documentary, from all of the from the Minneapolis Fed to Jerome Powell. It doesn't seem like they are unwavering or divided in their focus to hike. Now, to address the stimulus that's coming from the Fed going into the banking sector, it looks like it's sterilized QE. So it's a floor for the sector, but they are loans. They are not QE, not traditional QE that gets put into the credit market, high yield credit, stock market, Bitcoin, and speculative assets. No, it's mainly a loan that gets repaid back in 1 year, and the money is not able to go through the financial system that quick and come back. It's more for emergency purposes. With that kind of duration, it's just too quick of a turnaround to use in a speculative kind of way. If it was a no duration kind of money, then it's more likely to be used as a speculative investment or distribution. So by no means is it that way. That's taken from 42 Macro. 42 Macro is on point when it comes to his inflation expectations and also his interpretation of what the Fed is doing. So that's kind of basically what I see. If we were to take a look at just other key fundamental things, is we were looking for a retest on this 4-hour breaker on the dollar. We got it. So for higher movement, I'm not 100% sure that's coming. We might not even touch this 4-hour breaker. We need to keep our reservations open for higher movement on the euro, and if it does happen, but it's not guaranteed. We need to see if this 4-hour order block comes down here and starts pushing the euro down. And it would be significant if we see a weekly breaker on the euro. We have yet to see that. It has to move significantly in order for it to break. But we are under a 12-hour and 4-hour bearish order block. It's just a matter of it traveling. And I think today, I think there is news today, but today or Monday should reveal enough to where if we're going to want higher or not. And so that's still a thesis in action live. When it comes to the Japanese yen, we're retesting pretty hard into it and reclaiming, possibly reclaiming some highs. I don't know. It really, you have to wait and see just how this plays out. But that Japanese yen is looking pretty strong. The reclaim on this nested breaker that we got here on the dollar is looking pretty strong. We look at the VIX, that 12-hour order block, bearish order block's holding until this 4-hour order block on the VIX and the 12-hour order block on the VIX breaks. I'm not looking to take any longs. I'm only looking to take shorts here on out, and or just waiting for short opportunities. It just doesn't look good going into Wednesday of next week to take any longs right now. It's just capital preservation time and shorts only, short setups only, over extensions to the upside only. As long as Jim Cramer is bullish, I will be bearish, and that's kind of just the summation of it all, from U.S. dollar to the VIX, just A to Z. Now looking at the S&P 500, we do have a 4-hour breaker that's untested, so it's kind of like a toss up in the air if we're going to come back to it this or next week. But it could be just left naked for just the return to this level, and we're just not guaranteed that it's going to touch it. So we just don't know. We have to play level to level. And right now, the S&P 500 is at a significant level. It's at pretty much the weekly resistance. We've touched the weekly resistance, and we're coming down from it, and it's kind of leaving it up in the air how the week's going to close. I think the weekly close is the most important, and it's going to tell a lot of just what's going to happen next week. And if anything, maybe we get a whole bunch of volatility next week that we are actually able to touch this naked 4-hour breaker. Just a huge short squeeze. But that's pretty much it. Thanks for watching.